Magicians have bewildered the audience by replacing the Statue of Liberty into something which is infinitesimally small. The same magic also happens in shadow banking accounting. As a retail investor, not many of us know that there is an accounting procedure that makes things so opaque that it is literally impossible for even an expert who looks at data and information to directly conclude that yes, now this is going to cause a trigger for the entire world markets to crash. And this accounting procedure is called as the mark to market accounting, as against that of balance sheet accounting with the liabilities and assets. Stay tuned.
You hear the term shadow banking, and I mean, it sounds kind of sketchy, right? Like something out of a spy movie, all secret deals and hidden cash. But the reality? Well, it's way more interesting, and it's absolutely essential to how our entire global financial system ticks every single day. So take a look at this quote. It's really the core puzzle we're going to solve today. How can cash be visible, but the accounting for it is invisible? That sounds like a contradiction, but stick with me and we're going to unravel this whole thing. All right, so first things first, let's talk about what that word, shadow, really means here, because it's probably not what you're thinking. Yeah, let's just get this out of the way right now. This has nothing to do with illegal activity. We're talking about totally legitimate transactions. The shadow part isn't about hiding the money, it's about hiding it from the traditional balance sheet. It all comes down to the bookkeeping. To really get this, let's imagine we're running a massive global bank for a day. It'll make everything crystal clear. So, picture a giant like HSBC. Every day is just a whirlwind of cash. Billions are flowing in as deposits, billions are flowing out for withdrawals, and huge corporate payments. But here's the key. The timing of all that cash coming in and all that cash going out, it's never ever perfectly synced up. And because of that mismatch, a bank might get to the end of the day and realize, uh-oh, we're a little short on ready cash. Now, I want to be super clear. This doesn't mean the bank is in trouble. It's a totally normal, everyday operational thing, a temporary cash crunch that just needs to be fixed by morning. And when I say a little short, well, we're not talking about pocket change. To cover all its payments and obligations, a bank might need to find something like, say, $300 million, and they only need it for a few hours. So here's the puzzle, right? How do you get your hands on $300 million right now when you only need it until tomorrow morning? You can't just fill out a traditional loan application. That would take days. So what do? Well, this is where the financial system gets really elegant. It has a super fast, hyper-efficient solution built for this exact problem. It works like this. Bank A, that's us, we need cash, goes to Bank B. We say, hey, we'll give you these ultra-safe US Treasury bonds as collateral. Bank B says, great, and instantly wires us the $300 million. Then, the very next morning, we pay them back and they give us our bonds back. Boom, done. Simple as that. And that's the key difference. This isn't a loan in the way you and I think about it. It's a really fast, asset-backed transaction. The industry name for it is a repo, which is just short for a repurchase agreement. Okay, now we're getting to the heart of it. This is the big aha moment. This is where the shadow part finally clicks into place. Okay, look at the left side. With a normal loan, the bank's cash goes up, but a new $300 million liability, the debt, also pops up on the balance sheet. The whole thing gets bigger. Now look at the right. With that repo deal, you're just swapping one asset, bonds, for another asset, cash. It's treated more like a quick sale and buyback, so that huge $300 million liability, it never gets recorded in the same way. So even though the bank economically borrowed money, on the balance sheet, it's almost invisible. And that is our definition. Shadow banking is when a real financial transaction happens. Real cash is moving, but it doesn't show up clearly in the conventional accounting. Visible cash, invisible accounting. See? It makes perfect sense now. So you might be thinking, okay, that's a neat accounting trick, but why does it matter? Well, it matters because this invisible activity is basically what keeps the entire global financial system from seizing up. The best way to think about it is like plumbing. You never see the pipes inside your walls, but without them, your house wouldn't function. Shadow banking is the financial world's plumbing. It's the hidden network that keeps all the liquidity, all the cash, flowing smoothly behind the scenes. So just to sum it up, what we're talking about here is super short-term borrowing, almost always in US dollars. It can be for as little as a few hours, and it's the absolute lifeblood for the day-to-day liquidity that big institutions need to operate. It's the grease that keeps the wheels of finance turning. And here's the main takeaway. Every single time you swipe a credit card, or a company pays its employees, or goods are shipped across an ocean, all of that visible, everyday commerce is happening because this vast, invisible system is working tirelessly in the background to make sure the money is always there. So, this all leaves us with one final, pretty fascinating question to think about. We've just pulled back the curtain on one piece of the financial system's hidden machinery, but it really makes you wonder, if this accounting is invisible, what else can't we see?